Hello and welcome to the last weekly market view of 2012. Once again, I'm joined by Bill Hubard from markets.com. Thanks again for joining us, Bill.
Yes, thank you.
It's going to be a sad day, obviously, being the last day of our weekly videos. And I suppose, really, for many people, 2012 has been a good year, but for others, perhaps they'd rather see the back of it.
Yes.
For you, let's this time look at a bit of 2012 and maybe look at 2013. How would you sum up 2012? What were your highlights and lowlights?
Well, I think that the low light was probably, I still believe in the validity of the euro-dollar. So therefore, I was expecting the euro-dollar today to be 124, 125 rather than 132 hitting higher. And also, I think the equity markets did better than I expected. I think what you saw was the safe haven, the continuation of buying bonds, even in the third or fourth world. We've seen a massive rally of Greek bonds, Spanish bonds, Italian bonds. But I think one of the things that we have to look forward to is the bond market has to be over. And I know this is going to sound horrific. One of the things that we do need in 2013 is not, quote, rampant inflation, but we need inflation enough to get the consumer out there buying.
Really? But that's interesting you say you feel that the bond market rally is coming to an end. I mean, I didn't hear too many other people saying that. Well, it would seem like it would need the end to quantitative easing for that to happen.
I think one of the things that you've had is, if you look at the academics, and we're talking about going back to the 1920s, 1930s, quantitative easing was all set up basically as providing the input to gross inflation or improving inflation or growing inflation. And we haven't seen that. So the simple fact is that there was no reason for people to have inflationary fears. And I guess this being a bond man, ever since that slight problem we had with Lehman in 2008, people have gone into the safe haven of buying bonds, right or wrong. And I mean, I know the statistics are a little low, but I think by the end of 2011, more than 50% of pension funds, insurance companies, here in the UK, for the first time in more than 50 years, were in the bond markets. Well, if you look on real returns, they're negative. So hence the reason that we get some feeling that the politicians, and hopefully these, I guess I can't say the words that I'd like to say on television in reference to the politicians in the US, start thinking about the global economy, the world economy, and start forgetting about what Joe Bloggs and Fred Smith may think about locally. They start looking about getting rid of this, quote, fiscal cliff, which I'm not going to ever talk about again, and looking at providing the impetus for the world economy, hence the reason not being an equity man. Once this happens, and it may take the first 6 months of 2013, but I can see a very, very strong equity rally next year, the next couple of years.
Okay, so we've had a little look ahead there, but I'd like to focus on that more, because obviously, as you say, 2012 summed up, I reckon, by the euro has been a continual, sort of Achilles heel for the markets. It hasn't stopped the equity markets rallying. Risk very much seems to be, sort of on. So do you, as you just said, you foresee that going into 2013? But of course, if rallies going to happen in equity markets, then surely that means that bond markets are going to kind of sustain themselves?
I guess I have a problem with this word bubble. I mean, it's sort of, everybody likes to use generic words. The bond market won't disappear because banks will always buy bonds. Central banks will always buy bonds, as they will start continuing to buy gold. But I think one of the things that we may get back, and maybe this is another generic term, back to basics. I see gold improving. I'm not a member of the 2000 club for next year, but I mean, I can see it getting back to 1800, 1850, for the simple fact is central banks will continue to buy gold, maybe in lieu of buying bonds. Yeah. But I think it's a situation where, looking at whether it be insurance companies, pension funds, etc., they have just trillions of dollars, euros, Japanese yen on the sidelines. And if you are a pensioner, you don't want to have your pension fund all in bonds where the total return is actually negative, with interest rates being negative.
Okay, so just to sum up, 2013. Just tell us what are some of your key calls. You know, say for example, FTSE, gold, and Eurodollar.
I can easily see this FTSE, and I know we talked about this last week.
Yeah.
I know we talked about a 6 in the FTSE, but I don't think it'll be a major 6,000 for this year. I can see easily the FTSE 6,250, 6,500, because I think...
So next year?
Yes.
Wow.
And because I think, and maybe don't think me being anti-British, we're getting a non-establishment person as head of the Bank of England, who may start looking at what the Federal Reserve has been doing since February of 1913, look at non-inflationary growth. Yeah. I mean, how can somebody look 2 years forward on where inflation is going to be when I don't know where inflation is going to be tomorrow? Yeah. So I can see money coming, not selling the bond market, but coming out of fixed income, going into equities, because you've got so many major companies globally that will have a great year. Again, maybe I've been saying this for a while, I truly feel that the euro, I missed it for this year, but I do think this time next year the euro 122, 120. I think we're looking
at one.
Yes, and I think once we get rid of this nonsense with this fiscal cliff and the politicians taking over, the market, as we've seen, Federal Reserve quantitative easing part 4. I think we'll probably see quantitative easing coming from the Bank of England. We'll see some. I see at least one. I know one person I'm talking to is talking about 2 rate cuts by the European Central Bank. We saw stimulative programs from the Bank of Japan, where the market feels that the bankers now are looking to move the financial markets rather than the politicians. So I think we'll see, as a safe haven buying, I see gold at probably 1,800 to 1,850. I see the euro at 122. I see a very strong follow-through in the equities, mainly because the bond market has had a phenomenal run here.
Yeah. Well, that's very interesting, and thank you for your predictions for 2013. And I'd like to take this opportunity to wish you all the best, Bill. Thank you very much.
Thank you.
Very happy Christmas. And just one last question, what are your plans for Christmas?
To enjoy it.
Good.
No laptop, no mobile phone, and no BBC.
I didn't realise you had a
I don't.
Very happy Christmas, Bill. Thank you very much, and thank you for watching. And we look forward to giving you more weekly videos in the new year.